Now, a conversation with one of the most important policymakers in the world about the state of the U.S. economy, shifts in the job market, and a look at why Americans' wages still stubbornly lag behind other economic trends. I sat down this afternoon with the chairman of the Federal Reserve, Jay Powell. It was part of the Atlantic Ideas Festival taking place at the Harmon Center for the Arts here in Washington, D.C. Hello, Mr. Chairman.
Hi, Judy. How are you?
Delighted to be here with you and with everybody here. So, as we sit here on October 3rd, 2018, we seem to be in a Goldilocks economy. The economy is growing at a healthy clip. Inflation seems to be under control. The unemployment rate is down, some say historically down, and we have a stock market that just seems to keep breaking records. How long can it last?
I wish I knew. So you're right. The economy initially after the Great Recession began growing in the second half of 2009 and at times struggled, but we've made a lot of progress slowly over the years, and now I'm very happy to say that we are at 3.9% unemployment, is the lowest in 20 years. We're growing at about 3%, which is above almost everyone's estimate of the longer run trend growth, which implies that if we do grow at that rate, unemployment will go down further. If it does, it'll be the lowest unemployment rate in 50 years, since the late 1960s. Meanwhile, inflation is right at our 2% goal. So it's a remarkably positive set of economic circumstances, and we're working hard to try to sustain the expansion and keep unemployment low and keep inflation right on target.
But do you think it can go on indefinitely?
Indefinitely is a long time. I think there's no reason to think that it can't continue for quite some time, though. Eventually, external events, exogenous events happen, and not every business cycles don't last forever, but there's really no reason to think that this cycle can't continue for quite some time, effectively indefinitely.
So let's talk about two of those measures. Unemployment, you talked about it, it's under 4%, it's been declining. Inflation, it's hovered, around 2%,
right around 2%.
For a long time. Now, the Fed used to consider it a trade-off. When the unemployment rate was dropping, there were worries that inflation was going to go up, and vice versa. Has that cycle ended? Are we no longer seeing that kind of a trade-off anymore?
So it has changed. We can't say that it's ended. If you go back to the last time we had unemployment below 4% was the late 1960s. So for 4 years you had unemployment go into the mid-threes, and inflation took off. So there was a strong relationship between very low levels of unemployment and tight levels of resource utilization and inflation. And central banks around the world really stepped up and got inflation under control. And to the extent the public believes that central banks will keep inflation around 2%, which is one of our main jobs, that has tended to reduce the sensitivity of inflation to changes in unemployment. That's where we are now. But we got there by having a credible commitment to keeping inflation on target. So it's not something we have to keep that commitment. But for now, our inflation dynamics are that inflation remains at 2% and doesn't react very much even to further declines.
Let's talk about wages. Wage growth overall, still very sluggish, notwithstanding Amazon's announcement yesterday that it's raising the minimum wage there. Do you expect that to continue?
So wages, if you go back about 5 years, you saw that a range of wage and compensation measures were clustered around 2% growth. Now those measures are around 3% growth, which is sort of consistent with the underlying economics. Wages and compensation should cover inflation plus the increase in productivity, which amounts to about 3%. The mystery really is why in a very tight labor market, we get reports from all around the country, from companies in different industries, that labor markets are really tight, they can't find qualified people, so it's a bit of a mystery why they're not bidding up this scarce commodity of labor more. So we have seen a gradual increase in wages, and my own expectation would be that we would continue to see some of that, and it would be quite welcome. We don't think that we're in danger of a situation where, particularly imminent danger of a situation where wage increases are going to provoke price inflation, and our focus is price inflation.
But do you think something may have fundamentally changed about what's going on with wages? I mean, are we now at a point where workers' bargaining power has declined in a significant, long-lasting way?
There may be something in that, yes. It's a different, I think, in an era of globalization and an era of technological evolution, it may be that workers and companies have internalized the idea that lots and lots of jobs can be done all around the world or can be, supplanted by technology. So there may be something in that. I would say, though, it's, as we always say, it's too soon really to say. Wages have been moving up, and that's in keeping with a tight labor market, and we do expect that to continue.
Still on jobs, a number of experts out there who point out there were many people who were laid off from their job, from their work during the recession, who were never able to get back to full-time work, that many of them ended up in part-time jobs, and some of them just stopped looking altogether. How do you read that? What's your sense of that?
No, it's true. I mean, the financial crisis cost a lot of people their jobs and their homes and their careers and their hopes and dreams to some extent. And so we want to avoid that. Over the 10 years, really, since the depths of the crisis, we have seen a tremendous recovery in the labor market and the economy generally. Labor force participation is back up to normal levels, in fact, even indeed above normal levels. It doesn't mean that this strong economy is reached every American. It hasn't. We know that there are demographics and there are regions and industries and individuals who have not been affected and haven't gotten their jobs back. And so, these big negative events are quite costly, like a financial crisis. So we've done really a lot of things over the course of the last decade to try to avoid having that experience again.
So let's talk about something, I guess, your favorite subject, interest rates. Right now, it seems to me half the world is worried that you are raising rates too slowly. They say growth is so strong, the labor markets are so tight, inflation could take off. The other half of the world doesn't want you to raise rates at all or as much as you are. They argue you are widening the inequality gaps that are already out there, that, as we've been discussing, wages are too low. You obviously think you're threading the needle about right, but what makes you so sure?
So it sounds like we're doing something right. I'll talk about the two risks that you mentioned. So the first risk is that we move too quickly and we prematurely end the expansion, and inflation never gets solidly back to 2%. And that's always a risk at this point in the cycle, where the economy has been growing now for 9 years. It's in its 10th year of growth. The alternative risk is that we move too slowly, and the economy overheats, and that can show up in the form of too high inflation or financial market imbalances and that kind of thing. So you look at those two risks. So for a long, long time after the financial crisis, the second risk wasn't a risk at all. We were far away from full employment, and inflation was below target. So we kept rates low for a long, long time. We kept them at zero for a long time. And we had a lot of advice to move more quickly and raise interest rates, and I'm very happy we didn't follow that advice, because I think it benefited the country, benefited workers and their families. So now we come to a situation where unemployment, as I mentioned, is close to a 20-year low and headed lower by all accounts. And the really extraordinarily accommodative low interest rates that we needed when the economy was quite weak, we don't need those anymore. They're not appropriate anymore. We need interest rates to be gradually, very gradually moving back toward normal.
President Trump, as you've noted, he started out early on talking about how he believes the Fed should remain independent. And he's been given credit for appointing high-quality nominees to the Fed board. But he's also this past summer, criticized the Fed, the policy of raising rates. Do you write that off as, as just politics? Or does it put some kind of pressure on you as the chairman of the Fed, and does it harm the institution? Because this is something presidents have rarely done.
My focus is essentially on controlling the controllable, and we control what we do. What we do at the Fed. And, this is, to anyone who's known our institution over time, this is just who we are, and I think who we'll always be, which is we're a group who we we're quite removed from the political process, and we look at the best thinking, we look at the data very carefully, we try to get disparate views, try to come to a consensus, and try to do the right thing. We're insulated from political cycles because our terms they don't run continuously or at the same cycle as elections. And we just try to do the right thing for the medium and longer term for the country. And I think that's why a lot of people want to work at the Fed, is because there's tremendous satisfaction in doing that. We don't let other things distract us, and we're just going to focus on those jobs. That's just always how we're going to be.
Did you have a communication privately with the president after he made those comments?
No.
You said recently that you've been hearing a rising chorus of concerns from businesses around the country about tariffs. What exactly are you hearing? People
are concerned about rising material costs and tariffs and the loss of markets and supply chains in a big way. These supply chains have been under construction and now very fully built out over the course of almost a quarter century. So they're very important to the way the global economy works. We've been hearing concern about that. You don't see anything in the numbers, and maybe you wouldn't expect to yet, but we don't detect any slower growth or lower investment or lower hiring or any of the effects that might flow from more uncertainty on the part of business. What keeps you awake at night, if anything, when it comes to this economy and the world economy? Basically everything. Nobody wants a central banker who sleeps well, right? What good is that? If we getting monetary policy right, the question you started with is so important for the public, and so all of us who work at the Fed think this is the thing we think about all the time if we work on monetary policy, is we've got to get that right, and because the benefits of doing that are very broad for the country. And it's a world full of risks. Many things can go wrong, and I probably lose sleep over different things every night. Do you worry? How much do you worry that there could be another financial crash? My guess is that the next set of problems we have won't look a lot like the last set of problems we had. I think we don't detect measures of financial stability, of financial instability as being elevated at this time. They're sort of in the moderate range in our view of our staff, and certainly in my view. So it'll be something else, a cyber attack or some kind of global event. Those are the kinds of things. Or maybe it'll surprise us and look exactly like the last one. But you don't see the kind of buildup of risks in the financial markets, or let alone in the banking system, where we see much higher capital and actually less risk being taken. Meanwhile, we're in Goldilocks time. Your words, not mine. Chairman Jay Powell, thank you very much. Thank you.